I'm Philip. I'm M&A Director at Aventis Advisors. So we are an M&A advisory firm working primarily with technology companies, SaaS, software, IT services, also a bit with business services. And we've been doing these webinars for quite some time. And before that, we were focusing more on valuations, high level analysis of industry trend, what's going on with the multiples and so on. So this time we decided to be a bit more practical, kind of think about what is important for SaaS founders, what's important for SaaS buyers, and dig a bit deeper into KPIs in SaaS, how to calculate it right, what we are seeing on the market, what's going wrong, how to analyze that, and so on. Yeah, so if you're interested in some of our past webinars, you're welcome to get the recordings on YouTube or on our website. And today we wanted to dive deeper into churn rate calculations and how that impacts valuations of SaaS businesses. So our agenda for today is to speak a bit more theoretically, why is that such an important KPIs when everyone's asking about that, and why you as a founder need to know that. And if you're on the buyer side, why you need to ask that from a target company. And then I'll show you some example mistakes or top errors that people do usually calculating churn, and how we do it, for example, from investment advisory side, what we think is the best way to present it to your investors or to investment committee. So treat this as a kind of more educational, practical session. Feel free to ask questions in the meantime. This idea of getting this webinar is a bit different from what we did before, so would be happy to hear your feedback afterwards as well, and if it's worth continuing. So really, when we thought about this webinar, we first thought, okay, what are some of the important metrics for SaaS industry, and what's driving the valuations there, and if there is a one number there. And of course, there is company size, profitability, growth. Those are all important, but there are also a big bunch of abbreviations such as ARR, MRR, LTV, NRR, and so on. And SaaS KPIs, there's a whole ecosystem industry of calculating SaaS KPIs, how to get it right, how to present it to investors, kind of what's the right benchmark, what's the wrong benchmark. And we thought, okay, what's the most important of all of that? And that's definitely churn. Churn rate, we're seeing in our conversation, when we ask for that, it's a very important metric, and it allows us to understand a lot about the business. And we see the buyers are looking at churn rate to qualify targets, if it's investable or not investable. They're looking at it to provide the guidance on valuation multiples. They analyze unit economics, and that's one of the major inputs. So let me just share quickly the screen and dive deeply into churn. I hope it works. It should be working now. So calculating churn the right way. Today we're going to talk a bit about what churn shows, why is that super important for valuation, what are some of the mistakes that we are doing, and how these mistakes may affect your valuation later on. And just as a quick reminder, there's a logo churn, which counts number of customers that you lost over the customers at the beginning of the period, and dollar churn, which counts a lost revenue versus revenue at the beginning of the period. I prefer personally dollar churn. I think it's much more useful in forecasting, and I think as a founder you should track that more and give more value to that, while logo churn is a useful kind of in a separate analysis to see if it's higher or lower than your dollar churn. And what that usually means is whether your biggest or smallest customers are dropping off. So why is churn so important, and why, for example, for us, when we're talking to potential clients, we're asking that as one of our first questions? Really because it allows us to quickly qualify the company and get information about it, but not only about the churn rate itself, but also in a number of other other metrics. Yeah, so if I see a company which is 5% annual churn and a company which says to us 15% monthly churn, so from that number you can already imply quite a lot. So my first hypothesis is on their target customer. So 5% annual churn, most likely it's enterprise. Most likely you have very long-term customers. 5% annual means 20 years, yeah, customer lifetime value, while 15% monthly is just a couple of months. So you can immediately understand without asking further, what kind of market this company is targeting. With a higher churn, it's usually B2C, small businesses. And from that, I also implies the next thing, which is average contract value. So if you're targeting enterprise customers, low churn, then it's probably higher ACV, tens of thousands of dollars per company. If you're in a high velocity SaaS niche, so your ACV is like lower, single to hundreds of dollars. From that, I can also get the GTM. Yeah, so you're at 5% churn, enterprise customers, high ACV. So that's most likely sales-led, long sales cycles. You have a sales team that's quite expensive, and you go to market as likely through conferences, outbound outreach, working with partners. And I can already see just from this one number kind of where I should dig deeper during the conversation. And that as a founder, when you say a churn, you kind of directing the investor into the further questioning so they can understand your business better. And for 15% monthly churn, it's probably marketing led, high spend on marketing, not a big sales team. Most likely it's self-service on the website with lower ACV. And kind of at this point, you're just separating those companies in a bit different business model, organizational types, and everything will be different about them. And really, that's not to say that one company is better and other company is worse. Both of those companies can be very good. It's just two very different organizations. From that, I can also think next about profitability. And that's a big question for many founders. Should I be negative? Should I have negative profits? Should I be profitable? If you're at low churn, meaning high customer lifetime value, so you're investing a lot right now to get the value in the future, I'm kind of less inclined to look at the profitability now and dig deeper on your unit economics. Yeah, so I'm thinking, well, you're investing a lot in a customer which will be with you for 20 years, so that's okay if you're not profitable. Maybe sometimes it's even better if the company is not profitable, because you should be investing now into acquiring new customers. At the same time, in a high velocity, higher churn business, that should be profitable much quicker. Yeah. So if the customer is with you for a number of months, then there should be really good math behind it, and you should calculate very in much detail your customer acquisition cost and lifetime value. And that's where the churn is a big input in. So there I would expect that the profits, or at least the profits on a particular cohort of customers, is seen right away. And then finally, the scaling of the business. We learned enterprise, ACV, GTM, profit. So scaling in one case is sales team upselling with the current customers, working with those accounts, kind of learning more about their needs, trying to get more seats there. Or in a kind of higher churn environment, it's mostly via marketing spend, improving traffic, improving conversion, and so on. So this one number, why is it so important for investors? Because it gives a very good idea of where your business is right now. It gives some hypothesis on what other KPIs you have, and that allows us to kind of navigate further and direct the questions to the right area. And when asking you some for some follow-up data. It's a completely different set of data for lower churn company or for higher churn company. You wouldn't be spending so much time analyzing marketing in a high churn, in a low churn company, but you'll focus more on the sales team. So that number is super important for business, but also super important for valuation. Yeah, so it kind of the first steps that you've seen, the investor assigns your business to some group, to some category, and they're now deciding whether it's a right fit or not. But then they're going to be thinking, okay, what's the valuation of this business? And really, all the valuation is a DCF. Even multiples is basically a simplification or DCF. And churn here affects directly both the cash flows and the discount rates because it affects the growth and the risk. Yeah, so meaning that the higher churn you have, probably you're going to have lower growth rate, but your business is of higher risk. So that's why your valuation is going to be lower. So lower growth of cash flows, more customers are lost, kind of more difficult to grow at some point, especially as you scale. It's maybe okay if you're having 20% churn initially, but as you scale, just the sheer number of new customers that you need to add to kind of correspond to your churn rate is growing as well. So it's becoming more difficult to scale in the future. And then the big impact is also on risk. With the higher churn companies, there is a significant potential of a revenue decline. So if you're at a 10-15% churn months, basically means that your whole customer base is turning around in a couple of months. And you need a very good customer acquisition engine to grow. So if that slows down, then you're at a big risk that your revenue will start declining quite rapidly. And that can be seen for a lot of companies which are more organic driven, which are in SEO, social media marketing, paid search, paid acquisition, and so on, because there's a change in algorithm of Google, and suddenly you're lost 30% of your new customers, and you're not keeping up with your churn. So that's a super major factor for a lot of investors, and that's why kind of the investment in B2C SaaS and SMB SaaS are completely different industry, I would say, and a lot of investors don't touch that, and valuations are small as they're. Not to say that no one is interested in that, but it's just whole different group of people, kind of probably people who are much more knowledgeable about marketing rather than product and SaaS operations. And here kind of is a simple example of how company with different churn rate scales, assuming a fixed monthly rate, and there's just a massive difference in 12 to 24 months into where you're getting at with a different churn level. A couple of percentage points between 0 to 4, 6, or 10. It's a massive difference in your scale. And I think here we're showing monthly churn rate. So yeah, kind of two reasons why this is so important for valuation. First is scaling, and the other one is risk. So how to calculate this correctly and how to show this to your potential investors, and how to track this internally if it's such an important metric, and even minor percentage point differences are extremely important. So first we'll show some baseline rules that I think are important here for the calculations. And first, your revenue should be calculated on an accrual basis, meaning that the annual contract revenue is recognized over the 12 months. A lot of companies are having more monthly billing, so if you bill monthly, then naturally every month you'll have it on an accrual basis, you'll have a monthly recurring revenue. But if you have a lot of annual customers who are billed once a year and you recognize revenue in your books right now at the point in time, so like $12,000 in January. And to calculate this properly, you'll need to split this over the 12 months and combine with the monthly revenue, or to calculate it separately. So you calculate separately churn for monthly plans, you calculate separately the churn for the annual plans. And the other thing, which is also quite trivial, is that you should include there only subscription revenue. So sometimes if you bill some professional services, one-off installations, one-off charges for the beginning, don't mix it up with a subscription revenue. So if a customer is paying you 1,000 subscription and then the initial month is 5K for the setup, that should be separated so that doesn't affect your numbers. That wouldn't affect churn so much, maybe more upsell, downsell, but still it's good to keep that separate and calculate what percentage of your revenue is recurring. And then the other baseline rule is basically choose a time frame and metrics that's stable and makes sense. So a lot of times, when we ask someone, okay, what's your churn, we're seeing like a zigzag line, which is like up and down, and 7% and then 0 and 12% and then 0 again. Because maybe you don't have so many customers, and 2 customers leaving out of 20 is suddenly 10% logo churn. Yeah, so in such cases, we recommend to track something on the last 12 months basis where you sum up the customers that you lost over the last 12 months and divide it by some average beginning MRR. And then you just have a more stable figure, and you can track that over the long term and see minor changes, or if it's tracking up or if it's tracking down. So, and then when we're forecasting or we're analyzing it, we try to get to some number which is rather stable, so we can assume this number going forward for business and see how profits and revenues are going to develop. And then there are some more detailed guidelines, such as don't mix up logo and revenue churn. And we generally recommend to calculate both, prioritize revenue churn, but don't mix them up, especially if they're very different for a business, and report or track only one, and kind of don't say in one conversation one number, in the other conversation the other number, not to confuse people too much. And then also mixing this up can lead to big mistakes in your forecasting. So if you're forecasting something based on a logo churn and you're forecasting revenue, you may overestimate or underestimate that significantly, and we've seen that. So make sure if you're using logo churn, you're forecasting the number of customers and not the revenue. And if you're using the revenue churn, you're forecasting the revenue, and not the other way around. And the other one is use the correct denominator. So you always use the starting period customers or starting period ARR, not average or end of period base. You don't take into account the new customers that joined this month when calculating the churn, because they just joined you. So they didn't have an opportunity to churn yet. And the finally is match churn period to contract structure. So if you have mostly monthly contracts, and then monthly churn makes sense. If you have mostly annual contracts, and annual churn makes sense. So you can measure this both ways. In the end, and in my view, I prefer to look at everything annualized, even if it's monthly churn, or look at stuff at both monthly and both annual way to assess, into different manners. For some businesses, the benchmark is the monthly churn rate. For some businesses, the benchmark is the annual rate. So those are some of the basic rules that we use for calculating churn. And now I think I want to jump more to the Excel and kind of show how to do it in practice, how you can implement that in your company, how you can I don't know, delegate it to someone from your finance team or analytics team to calculate that. And what we think is the best way also to show this to investors or advisors or anyone else. So I'll stop presenting for a moment and switch. If you have any questions in the meantime, I'll share that. Someone's asking if we're going to get the slides. Yes, we'll share the slides, the Excel, and the recording afterwards. So it's a bit of an we have a question in the meantime. Maybe I'll answer that. If contracts are periodic, what's an appropriate churn window? I think I would be inclined to say that it's annual. You'll calculate annual churn. But then again, also when we're getting into discussion if it's a really SaaS business or not a SaaS business, for a periodic customers where it's, the customer stay with you for 3 or 5 months or 6 months only, you're gonna get to a very high number if you start calculating churn. But that would be the nature of the business most likely. Yeah, that customers come to you for a couple of months, they use your software, and they leave. Yeah, I hope I got the question right. So as a bit of an introduction, there are different ways to calculate churn, and a lot of you probably have the accounting system. You'll have your Xero, QuickBooks, Sage, and so on, and you'll have your billing systems. Your Stripe will show some KPIs. Your ChargeBee or some other software for tracking the KPIs. They also are showing some numbers. I think if you're satisfied with that, it's okay. Yeah, I'm sharing the screen. If you're satisfied with that, and if you see there are no major issues there, then it's okay. But we're also going to show you kind of what's the way to calculate it specifically for some purpose. If you want to get this right, and just cross-check if your SaaS KPI systems are doing it right. So what's most easy to get, because you track this with the accounting, with your accounting provider, and because it will sum up to your revenue numbers, is some kind of invoice data. And that's where we like to start as well, mostly because it's gonna sum up in the end to revenue number. The sum of your invoices will be your revenue for the year. And as finance people, we kind of like when stuff sums up and adds up, and your breakdown of your revenue actually is equal to your total revenues that you report somewhere else. In some of the billing systems, you may have returns, refunds, trial periods, kind of all mixed up. And if it's not separated properly, then you don't get the right picture. So here, when we look at the invoices, we know we're speaking only about the paying customers, and we know we can assign them to someone. So something that we can get here, and we got here is some example data. Is just your list of invoices with the date of issue. You can assign the month of issue to it. You have a customer name, the value of invoice, whether it's monthly or annually, maybe some index for the month. And then you can export that from your accounting system, get a number of records. You have a couple of hundreds or a couple of thousands records. And based on that, you can start building your MRR bridge, and which you'll have the churn number. So to start off, get into the right figure, I'll go here. I've created a simple pivot table where I have my rows, which are customer names, and I have my columns, which are months. And I can just see a typical picture for a SaaS business. Customers pay every month. Sometimes you have new customers joining, they start paying. Sometimes some customers are lost. They stop paying, so that's a churn. Some customers maybe increasing their spend. So here we see from 2,000 to 3,000, you're upselling them something, you're downselling them something. Yeah, you have the new ads. I use here only paying customers. Yeah, that's the best metrics. That's the best metrics. It's a metric, of the clients who are actually paid. You can use some free or trial customers, but I wouldn't recommend to combine them, as the numbers there would be much, much worse. And then based on this, you can basically start to creating your MRR bridge. Yeah, so I'll show quickly here. I have already created that. You have the MRR bridge for logos, for number of customers, and bridge for the MRR. I just count if more than 0 all the logos in the table. Then I add here new logos. So some company which had 0 value in January, but then they started to have some value in February, or churn logos. Yeah, so if I see a set of numbers where someone had a figure, someone was invoiced in January, but not anymore in February. And then I get this churn logos. Yeah, so we had 59 customers in January. In February, 5 customers came in, 4 customers were lost. We ended up with 60 customers. Yeah, so that's quite a standard calculation for number of customers, simple, based on the invoices. Then the same I'll do for MRR. Here's a bit different. Here's not count if, but sum if. I'll just sum for the first month, all the monthly payments. I'll add their new MRR. So if someone had 0 in January, but then they started to pay something in February, then I'll do net expansion or contraction. I'll subtract from all the customers who have values in both periods. I subtract the difference from the later period to the earlier period, and then we'll get net upsell, downsell. That's going to be here. You can, of course, split it to upsell, downsell here for simplicity. I calculated this in one place, and then your churned MRR, just if a customer had the value here in a particular month, and then they stopped having a value. So, for example, here, as those 2 customers have churned. And based on that, you'll have your first input and your MRR bridge for the full year. We're seeing the company was kind of flat on the number of logos they added. They added a lot in the first half of the year, and the number decreased, but they grew MRR in the meantime. And we're seeing here the logo churn, average of 5%, and we're seeing here the dollar churn rate, average of 2% a month. And so here is an example where it's not quite close, meaning the company is losing their smallest customers. Yeah, they're not losing their biggest customer because dollar churn rate is rather fine, but they're losing their smallest customers because the number of customers is getting lower or stays the same. And then I have the churn calculations for the month. Average is 5%, 2% dollar churn. And I get somewhere 47% annual logo churn, 26% dollar churn. That's kind of not too good, not too bad. It's probably a business which is not, the largest enterprises, but still has some good customers. Of course, with an example names like this, you would expect a much lower churn, but here's just an example. And then you have this raw data calculations. So that's what sometimes we get from the companies or from the calculations, because it's quite straightforward. You can get this from the systems, or you can get this from your billing. Yeah. The next thing is that we're starting to look at is is there any ways that our data here is wrong? Because we're working with raw data, and I have still to see a case where everything is perfect and everything makes sense. And usually there is a way to improve this baseline number by at least a couple of percentage points, but sometimes quite significantly. So if you first thought I calculate my churn rate is 26%, and let's use this in forecast and let's report that to a potential investor. Well, first, we always kind of look in a bit more detail in the data to see where are the errors and how could we overestimate our churn, which is a super important number for valuation. And there are a number of ways, and there are three top ways which are quite simple, but also sometimes correspond to a big percentage point of churn improvement just because the data is never perfect. Yeah. And those ways are quite basic. So the first one that we look for and we check, especially if you have a long period of operation, especially if you have a customer, kind of big customer list, is just the customer names. Yeah, we see a lot in invoicing. There can be cases where, like this, like in this example, in one period it's invoiced to Apple, in another period it's invoiced to Apple Incorporated. So those are kind of in our calculations. This will count towards. And you add Apple Incorporated and here lost customers, and we don't want to see that. So that's one thing we need to correct. And that's a very simple case where it's just, there's a billing difference in your database of billing. If you have a subscription ID and you have subscriptions assigned and your system wouldn't get that or would catch this error, then it's great. A lot of times we don't see that. So you may need to check this manually. That's a simple case. If you have a long customer list and other things that can happen, a rebrand, changing customer name, so you're not going to be able to sort easily like this here and notice, oh, it's Apple and Apple Inc. And here I think we had some other Meta and Meta Inc. Yeah. Facebook changed to Meta. Yeah, you need to catch that if you change on your invoicing. So name changes, rebrands, can add up. And the other one, which is the most difficult one, is acquisitions. And we've seen this actually in practice. So, for example, you've been billing to Paramount, and then in a couple of months, you started to bill into Netflix. You bill into Warner Brothers, and you started to bill to Netflix. Quite difficult to catch, The company got acquired, you started to bill into their parent entity. If you have subscription ID, it's great. You can catch it. If you have only invoice data or some financial data, you need to get this manual. And for big customers, this may be a big change. So that's the first one that we see quite a lot. The other one is slipped or delayed payments. So you will see this as kind of holes in this series of payments. Yeah, so here we see for most of the customers, every month they pay the same amount. Sometimes it increases, sometimes it decreases, but mostly it's the same every month. But sometimes we may think something like this, where a customer paid 2.4 thousand a month, and then there's a gap, and then there's 4.8 thousand. So most likely they paid for this month, and then they continued. Yeah, so a formula would catch this as a churn and a new ad. Well, it's definitely incorrect. You may have negotiations with an enterprise customers. Yes, it's quite realistic that at the end of the billing cycle, the negotiations took longer and they paid 2 or 3 months late, but they still paid for the full year. And you need to catch that and see that for this 3 months, this was not a churn, or for this 1 month, this was not a churn, but the customer was still with you and we don't count it towards churn. Or it's just some invoicing issues. The customer asked you to kind of bill next year for whatever reason, some delays, or just some mistakes in your system. Yeah, so you need to catch stuff like this. This can also correspond to some churn in here, like you can see an example like this. Yeah, you'll see it just visually from analysis of the data, or you can write some formulas to analyze where there's some unusual payments from some customers. So that's the second most likely case. And the third case, which is especially relevant for companies which have both monthly and annual packages. A lot of times, the customers will be moving between those packages. And if you're analyzing only monthly customers or only annual customers, you may see that their monthly subscriptions ended, and they are not a customer of a monthly subscription. And in a table like this, you'll see a case where Microsoft was paying $2,000 a month for the first 5 months. But if you look at the annual billings, you'll see that, well, in June, they bought a 40,000 subscription, which is annual and 20 times bigger. So our standard formulas will calculate this as a churn. If you're even if you have a good subscription ID and you change the subscription ID, this will also be calculated as a churn. So to get your numbers right, you'll need to check for all the cases where customers moved from monthly to annual and from annual to monthly. And in this here example, yeah, like we have this kind of simplified, made up data. And just to show you the illustration, how it was before and how it was afterwards. Before we had 26%, and after we implemented all the changes, the churn dropped to 18%. So quite a significant change. If you're at the lower than that, if you're kind of noticing difference between 5 and 15 or 5 and 10%, that's even bigger effect, because that's a two times difference. So here, move to annual, we mark this as a separate item. Then we, in the fixed data, we manually adjusted some invoices. So Salesforce, for example, we split this invoice into 2 to show that this was a payment for 2 months. And we unified the name. So if someone was like Meta and Meta Inc., we just manually change this name in our table to correspond to that. And just these 3 simple things decreased our churn by quite a lot. Yeah, from 26 to 18. So 8 percentage points. So super important to have this right. It didn't increase so much the logo churn, but it increased quite a lot the dollar churn. And those are just some 3 most popular examples that we saw in our practice, and we're seeing that repeating just because the billing systems and accounting systems are the same, and the types of errors and kind of business cases are the same. Well, we need to analyze that, fix that, and then improve your churn number. And you can see here we're not doing actually any manipulations. We're not trying to show the business which is better than it is. We're just fixing the errors with the data. If you wanted to think about how to position it, that would be a different. We would probably show maybe churn separately for the biggest accounts and separately for smallest accounts, because our biggest accounts are not churning as much as our smallest accounts. And how do we know that? It's because our logo churn is higher. It means we have a big number of customers churning, but the revenues we're losing is not as big. How that affects valuations? I did a super simple model to show that this is, actually a couple of percentage points may make a difference. I have here super basic forecast. We have here ending ARR 1.7 million. I said, let's add 1 million ARR every month, and net expansion or contraction, let's set it at 0. And then the churn is 18% of your opening ARR in one case, and we'll compare it to other case. We'll have some revenues based on that. Revenue is the average of opening and ending ARR to kind of estimate accrual. And then we have some fixed operating costs. And then some EBITDA. Yeah, so revenue minus costs, we get to EBITDA. So with 18% dollar churn, kind of realistic, someone will be doing your forecast will get to 1.2 EBITDA, 3.8 forecast. If you plug in 26, it accumulates. Yeah, so your 3.2 ending ARR, 700,000 EBITDA. And if you think about the valuation here, I did some simple, very, very simple methods like DCF, just assuming this cash flows and some terminal value, or 3 times revenue in 29, you exit discounted to now, or 10 times EBITDA, 26% churn, the average value I get is 3.8 million, 18% churn is 5.6 million. It just accumulates, in your EBITDA forecast, it accumulates in your revenue forecast, it accumulates at your cash flow forecasts are lower every time. So it's really important if providing this number to someone and they're going to be forecasting your business based on, for example, fixed ARR, then you have this number right. But it doesn't actually matter of what new ARR you have, if it's a percentage basis or if it's a fixed number or whatever, it would still make a major difference just because, as you scale, percentage of your opening ARR gets higher and higher. So here you've added 700,000 of new business. Here you've added 300,000 of net new business. That's why it's such an important metric in valuation, because it multiplies this percentage by your total revenue. So that's basically it for the Excel. I know there are a number of other mistakes that you can make, and we've seen all kinds of things, all kinds of issues in data, especially if you combine your data from a number of sources. If you have an accounting source and then your billing source, and then you have some place where you turn the subscriptions on and off, and for some customers you turn it on a bit earlier because they had a demo, and for some customers asked you to prolong it for 1 more month. There are just so many business issues that can get in the way in the right calculation. But kind of what I wanted to show tomorrow is that, number one, this is super important metric for understanding your business and kind of putting it into a particular category. And number two is that it's super important for forecasting and valuation. And that's going to be a big input into valuation. What we're seeing most of the time when we look at the actual sheets like this is that the churn number is one number which is rather flat and fixed and easy to forecast. So if an investor, or if you're seeing that you've had 10% for the last 2 years, then they're going to assume that's going to continue, especially if you have 100, 200, 300 customers. So just the math and the rule of large numbers, that most likely customers are going to churn at approximately the same rate, unless you're doing some specific initiatives to change that. So we're going to be sharing this Excel with you. We're going to be sharing the presentation so you can play a bit with the numbers. And now we can move to Q&A and let's answer a couple of questions from the audience. So first one, if enterprise clients, is there a standard contract length, and what is a good way to forecast churn before contract expiration? So for enterprise clients and longer term contracts, I think the best way to forecast churn is to be in touch with the customer. So most of the time we see there's an account manager and they're asking the customer before the end of contracts, are you considering other, or what are your kind of, how do you like the software? What are the problems that you have? Are you thinking about changing something else? So the only good ways to forecast is by asking the customer. The other one is to track your product metrics. So if you have some product analytic tools and you're seeing that the kind of the renewal comes up, but the customer is not using it, using it much less, then there's a good way to assume, or to make some tool to forecast whether this customer is going to churn. What do you do if a customer has a subscription holiday? They may stop a month or two while they don't use the software and then come back. Yeah, so for me, subscription holiday is not a churn for sure. Yeah, I would track them. I don't know. I would put them onto some separate line. Like here, I created the line move to annual, so I would create a line something like subscription holidays and just subtract the revenues that you don't have in 2 or 3 months to get your MRR bridge to match up, but don't have it here in the churn number. Yeah, and of course you may have subscription holidays every now and then, and it may be a stable part of your business. I wouldn't count it as a churn. I would count it more similar to upsell, downsell kind of thing. Yeah, it would be probably used by an investor in forecasting that you have a lower revenue than kind of your ARR, but it shouldn't be a churn. Can we get the Excel work you've done to play with the assumptions? Yes, we're gonna do that. We're gonna share that. When converting monthly to annual churn, should you take the monthly churn figure and multiply by 12, or is it better to use some kind of compounding? The right way is to use a compounding. There's a formula available where it's something like 1 minus, in parentheses, 1 minus monthly churn to the power of 12. So that's a better way to use this, and especially if you have higher monthly churn, then it will make more difference. All right, so if there's no more questions, I hope it was useful and practical webinar for you. We'll be sharing the deck and the presentation for you. If you have some case study, or if you have your numbers, your sheets, your calculations, and you want some help or support on that, you can get in touch with us and we can think what we can do. A lot of times when we look at those sheets of MRR, we do recommendations not only about data and finances, but also about your business, because then we see that your churn rate is too high or it's too low. We analyze it also in terms of your customer lifetime value, your customer acquisition cost. Maybe you invest too much into customer acquisition given your churn rate. Maybe you don't invest enough given your churn rate. We see this a lot. If your churn rate is low, then you're justified to overinvest now and kind of be unprofitable for some point in time, because you're going to get all this money back over time. So if you're looking for any kind of support in that, feel free to get in touch. It's been a pleasure to lead that. If you have any feedback to me or to topics that you want to cover, or whether it is useful for you or for your team, feel free to share that with your finance or operations team as well. And thanks a lot for joining us today, and have a good rest of the day. Thank you.